Hey folks, why real estate investment trusts are crashing, or dare I say they're more or less in a correction period. A lot of them over the last year in that time frame were largely outpacing the S&P 500, and it looks like they're pulling back. So the question is this a buying opportunity? Well, what I'd like to do is compare growth REITs versus income-based REITs. I want to talk about the earnings per share, how we value them, because many of these REITs right now are overpaying what they can afford in the dividend, or so it would seem if you're looking at statistics on Yahoo Finance. And then we're going to talk about a little bit of the interest rates and the inflationary market and what that means for real estate investment trusts moving forward. If that is a conversation you can appreciate as we review some of my favorite REITs in Canada and the US, in return, I simply ask that you hit that like button, folks, because we have a lot of earnings coming up, and a lot of the dividend investors out there love Realty income in the US. They're going to be posting earnings May 5th, and recently they have been pulling back from their all-time highs. They're trading down about 8 to 10% with a current payout of 4.38% on that dividend, or the distribution as it's called, with a market cap of about $40 billion. They haven't been able to retest their all-time highs, but are they deserving to retest those all-time highs? That's a question we're going to ask. But first and foremost, if you scroll into Yahoo Finance, you look up Realty, go into the statistics section, a lot of people will scroll down and take a look and see that the payout ratio is 327%, meaning they can't really afford that dividend. But that isn't accurate, because if we actually go into the dividend payout, we can see just before Christmas of last year, they increased the dividend from 0.246 cents to 0.247 cents a month. So how is a company that doesn't have income to cover the dividend able to increase it? Well, trust me, they're able to afford the dividend, and I'm going to explain why. But most people would use regular stocks. You can't look at things like Apple or Microsoft or Google or Tesla and kind of give them the same comparison when we're looking at charts like this, because up here we can see the stock price versus the net earnings per share, and then the price to earnings ratio, which we see down here. And we all know that the PE ratio is basically how many years it would take for us to get a full rate of return at the current growth and the market price, right? And currently, the PE sitting at 77 is astronomically high. But again, we cannot take a lot of this into consideration with REITs because of how they operate from a fundamental and balance sheet perspective. So first and foremost, if we go into Realty's balance sheet here, guys, the first thing that I like to look at is the rental revenue income, because this rental revenue right here really dictates the growth of the company. We can see from the end of basically 2020, they went from $1.6 billion to where they sit today at about over $2 billion. That is a massive growth rate and one of the most challenging years in the market for REITs coming out of that pandemic. Offices getting destroyed, theaters. There was a big clump of a lot of confusion with especially REITs like Realty that hold things like theaters, right? But where we want to pay attention to is in the depreciation and amortization cost, right? This REITs kind of operate loosely. I wouldn't put it an apples to apples comparison here, but let's say you bought a brand new vehicle, right? And you're going to use that vehicle to generate income at a business. Let's say you have some kind of operational vehicle like a truck for landscaping or something like that. Just because you bought the vehicle this year means you're going to be able to write down some of the value on that vehicle, even though it's going to be able to produce the same kind of income over time. It's not like that vehicle is just going to go kaput the same year, right? But you can devalue some of the asset, even though it's still going to generate more and more revenue if your business picks up. So that's kind of a fun way to think about it. But we can see their amortization cost went from $677 million to about $897 million. That is an astronomical increase from an amortization, and this is a very controllable thing in the market. It's kind of based off perspective. So they have a lot of these REITs have very good basically financial officers that are good at really good at working these numbers. But what we want to pay most attention to is if we scroll down here, guys, well, the first thing that we can see is the loss on extinguishment of debt. So we can see that they're extinguishing a lot of debt here. I mean, almost $100 million worth of debt over this time last year. But when we take a look at the EPS numbers, this is where we're getting that charted line. We can see that the last EPS numbers were 87 cents, which we can actually see reflected on this balance sheet. And that's what most people would look at. But because of those amortization costs and things that don't really reflect onto the bottom line, you can't take that as a fair comparison to their net income of cash flow, right? So what we want to pay most attention to is the funds from operation, or the AFFO, the adjusted funds from operation, which we can see here, guys, was actually sitting at a whopping $3.39. And if we take a look at the cash dividend per share declared over the year was $2.83. But so long as these numbers, the adjusted funds from operations, sit well above the cash dividend payout, it means that they're in a fairly robust situation to continue paying that dividend. Do not trust the EPS numbers because it takes the amortization cost into conclusion, right? So this is why you got to be very careful with REITs. Now, moving forward here, guys, one thing that you got to note, things that we're going to talk about with many of these REITs that I love, is they've all really done a good job at restructuring their balance sheet, paying down debts, and getting a lot of access to liquidity for potentially good purchases and future, investments with whatever real estate they think is going to be at the best value for their shareholders. And right now, Realty has basically expanded the revolving debt to $4.25 billion. This is something my favorite REIT, RioCan, has done, which we'll talk about in a second. And the thing we have to be a little concerned about here is basically in an interest raising environment, usually that debt that is unsecured is inflicted by the raising interest rate environment. And usually real estate investment trusts will get hit in this market because obviously the more debt they have to pay is less money they're able to put in future real estate investments. So that's something that I think is coming into consideration right now with this pullback that we're seeing in the market. Now let's look at a few other REITs. I mean, American Tower Corp is the largest real estate investment trust in America, largely encored by a globally diverse portfolio of basically telecommunication real estate, where they sell and rent real estate to the telecom providers on a global basis. This business model has been extremely fruitful. In the last 5 years alone, this REIT is up 86.95% and has had quite a recent healthy pullback. Now, because this is a growth-oriented REIT, they tend to do things a little bit differently. Most of these growth-based REITs will mostly include a lot of dilution over time to constantly make reinvestments so they don't have to take on extra credits. However, American Tower Corp has been doing something a little different than most of the growth REITs I've seen, because the shares outstanding, this dilution hasn't actually been going up. And what they've been doing is utilizing debt to buy these properties and then obviously lease them to the telecom giants. And obviously telecom is probably extremely stable, so they can trust that this debt is going to be relatively secured over a long period of time. But we can see that their debt has gone up just as dramatically as their assets have. So we have to ask ourselves when these mortgage rates might come due, because if their mortgage terms are only locked in for 3 to 5 years, well, that means when that mortgage comes due, they're going to be renewing it at a much higher interest. And this is something that you want to take into consideration. It could be one of the reasons that American Tower Corporation could be pulling back, but I haven't done enough due diligence on this one, but just something to note if this is a company you're interested in. But coming to the Canadian side of the border here, RioCan is going to be posting earnings on May 10th, one that I'm highly fixated on, and I would not consider this a growth REIT. What I want to talk about now is the difference between income REITs and growth REITs, because a lot of people are always like, why would you buy this when it's not growing? I mean, the stock price has been relatively flat since the 2008 financial bust, and the company is not generally be doing much other than paying out a dividend that hasn't been increasing. So why would these REITs be generally attractive? Well, I'm going to talk more in depth about the company in a second, but most people that want income today, I wouldn't be buying these kind of REITs expecting to outperform the market, rather giving you cash flow today to invest elsewhere or use to pay your bills. Because if you can yield over a 4% dividend, that is a lot of extra money coming in off an investment in a year that you could perhaps pivot into the S&P 500, which would conclude into the RioCan growth, right? Like if you're reinvesting the dividend, that would compound how much dividend growth you get over time, and all of that has to bake into the return, which would actually lead to a higher performance than what we're seeing in this chart. So we have to understand, when we're looking for high yielding REITs, we're looking for cash flow today for reinvestments or for paying bills. So we cannot really take it into the conclusion of a growth REIT, right? We're not buying it for that aspect of it. We're looking for growth of dividend income. So we get dividend income, we can either reinvest it for further growth or use it to pay bills. So that's why I kind of like RioCan. And honestly, through this mess that they had similar messes to Realty here, we can see that their actual PE ratio is gone back to a baseline, right? I mean, historically, if we're using the EPS numbers just as a baseline understanding of where the company was in the past and where they are now, we can see their historical PE tends to hover around 10 to 13. Currently, they're sitting at about 12.25. So we can see that this REIT has actually started pulling back about 5.47% over the last week. I mean, they are down quite a bit from their all-time high over the last month, about 11%. And it looks like they're just pulling back to a medium here, because this would probably be around fair market value for the company. And this is what we've seen over the history of RioCan. Usually it goes up and it comes back down and it hovers around this area. So it looks like we could still see a little bit of growth, presuming that the company has worked out some of their issues, because obviously, like many REITs that had theater exposure, mall exposure, which RioCan heavily does, I can't remember if it's much more than about 10 to 15% of their entire portfolio is really hindered by the pandemic, but they've come out of it very nicely. I would say that these kind of REITs you want to buy on those major dips. Obviously, if you could buy it down here to get that cash flow that we locked in, that's kind of where you want to start approaching these income-based REITs, is when they dip. So this could be a good buying opportunity for fair market value if you want to lock in a 4.41% dividend yield. Same thing with Smart Centers here. Smart Centers is one that I recently started buying. And again, when we look at them year to date, guys, a lot of them aren't down nearly as much as the S&P, and a lot of them were largely outperforming the S&P. So I think it's healthy for them to go into a correction, as looking forward, any of these companies trying to buy future real estate based off debt, they're going to be paying a higher premium to do so. So perhaps the market's just calculating that in, moving into the Fed meeting is what it actually looks like is happening, because the Fed meeting starts, I think, today. We kind of get the minutes coming out May 5th. So it's kind of funny how going right into that Fed meeting into May, we see this kind of healthy correction in these real estate investment trusts. But these are Canadian REITs, right? So, I mean, they kind of trade at par, I've noticed over the last 5 days, similar to these US REITs. And I can only presume it's based off that Fed meeting and the interest rate hikes, similar to the Canadian Treasury, right? But let's take a look at some of these other REITs that I do like Medical Property Trust, Northwest Health Properties. These are wildly different REITs because they're based off the healthcare sector, and they do not offer any kind of material growth, in my opinion. But again, these are income-based REITs, because what's more secure out there than anything that's hospital or basically medical related, like your CVSs and things like that, right? So take a look at this, because this company here, guys, is currently paying out a 6.15% yield. I do not hold Medical Property Trust anymore. I did, but I still see these as something that would be a really great proponent to a retirement portfolio. If you're not really inclined to think as much about getting that rapid growth, then these are great REITs to be looking at, in my opinion, because they're both yielding over 6%. I think MPW, Northwest Properties, have been more known for the dividend growth side of things as well, but we're not talking about substantial growth. These are just fairly reasonable. So let's go into the growth side of the spectrum now. I want to more or less focus on stocks that I like diversifying my real estate sector with. And Canadian Apartment Properties is a new one that I've started adding on this dip, because they're down pretty massively year to date. They've dropped about 20% from their all-time highs. And they've been pulling back, kind of getting back toward that baseline that they saw after the March 2020 crash. And I think this is setting up for very good value play, because this company is still making a large amount of investments. They do obviously a lot more dilution to avoid taking on that debt. And obviously, if real estate keeps going up, then that means our asset value, or our shares outstanding that we're diluting, actually gain better value in this market if you think real estate continues to grow over the long period of time, right? So that's kind of how these REITs have sustained really good growth. But again, you're sacrificing that yield to get higher growth, but usually these guys do a good job of increasing the dividend over time as well. Again, not to the extent of something like a McDonald's or JP Morgan or Johnson & Johnson, but that again is because these are primarily income focused, right? So let's talk about Stag Industrial, because Cap REIT is Canada's largest residential real estate investment trust with something like 70,000 rental units. Imagine buying one stock and getting exposure to 70,000 rental income units, which is just so much more attractive to me than going out and trying to manage one piece of property on your own. But again, everybody has their own preferences, right? So Stag Industrial has earnings coming up actually tomorrow, which I'm going to be watching. And this one probably got a little overheated coming out of the pandemic, as did probably Canadian Apartment Properties, because so many people were flooding into residential properties. So there's a lot of hype. So we're probably seeing the consolidation from that, because Stag, again, having tenants like Amazon, I think they have tenants like Tesla. They're very diversified and people looking for logistics and shipping. And obviously, I still think that's going to be a booming industry. And obviously, with everybody doing shipping and working from home, this stock grew by like 54% coming out of the pandemic into 2021. And again, it looks like we're just seeing a healthy correction, a bit of a pullback here. And I still think this company is going to do exceptionally well moving forward. So I'm really happy with this one. I like my REITs. They're very different aspects of the stock market, and I think they have their own little diversification method for income. So Dream Industrial is one very similar to Stag, and it is well pulling back in a very similar fashion to Stag. And again, a lot of this could be related to the Fed meeting, maybe a little bit of overhype in these companies being more stable during the during the pandemic, outperforming the S&P 500. And like I said, now we're seeing this kind of healthy correction period here. Another really interesting one is Digital Realty Trust. A lot of people are looking at moving into these cloud computing REITs, which are also very stable in this kind of a market. They tend to trade a bit of a higher value, but they've done a great job growing these as well. So I've been keeping an eye on these, but these aren't REITs that I primarily hold outside of Stag right now, but you can kind of get this really nice stability. And this is a massive REIT. This is a $40 billion REIT here, guys. And again, don't trust the PE ratios as much, because they're all based off the EPS numbers. So you're going to want to do deep dive due diligence based off some of the things that I showed you with Realty Income. And then you can kind of get a baseline. I always try and just make sure that that the dividend payout is at par. They can afford it. You know, the tenants are stable, they're resilient, and they're reliable. But honestly, a lot of these companies at this point, guys, have really adjusted their portfolios to stabilize coming out of the March 2020 crash. So I think they're in a much more resilient place to bear a higher interest raising environment. And again, I am primarily just holding these for cash flow. So I try and mix a little bit of income today with a little bit of growth REIT potential moving into the future and get a nice balance of both. So you're still keeping at par market returns while collecting an increased cash flow to reinvest in my situation anyways. But at this point, I want to pass the question off to you. What are your favorite REITs out there? I will be doing a REIT coverage when we're talking about earnings once we get through most of the big REIT earnings that I like. So consider subscribing for that. But on this note, stay cool, stay awesome. And as always, I look forward to catching you in the next one.